Good evening, all the joinees. Hi, this is Ansu. I welcome you all to the webinar conducted by NGEN Research. We will be beginning shortly. By the time the others join in, let's have a look at today's topic. So today we would be focusing on how you can review your client's portfolio and the various methods of generating reports for the same. Firstly, we will be looking at the asset allocation of the portfolio, mainly looking at the exposures that come towards your portfolio. Second, we would be comparing the performance of the portfolio with its respective benchmark. That is auto benchmarking that happens on the platform and what all are the crucial points that can be seen while comparing performance of a portfolio. Next, we would be looking at the contribution analysis as well as the rolling analysis, which highlights how each fund individually contributes to generate portfolio return as a whole. The last topic would be the returns distribution and the scenario analysis, wherein you can create in your own customized scenarios. You can input your start date and end date and view the performance of your portfolio in that given scenario. Finally, the forum would be open for a Q&A. You can either unmute yourself or type your questions in the chat box. So let us begin. So this is our NGEN Markets terminal, wherein the landing page is the Markets tab. So for our topic related webinar, I move to this portfolios tab. Right here, I would be loading in a specific portfolio. I have this portfolio. I just click on the drop down and I'll click run. So right here, this portfolio has gotten loaded and you can see that currently this is a 9-item portfolio. The name of each fund or each component that forms a part of my portfolio is mentioned in this first box that you can see. And next to the name of each fund, you can see its weightage in the portfolio. Currently, this is an equally allocated portfolio, meaning each component has an allocation of 11.11% in my portfolio. The next box shows us the start date as well as the end date, and you have an option to change both. Next to the start date, you can see an option called as change. You click on that. Let's say I want the analysis for the last 5 years. So I go to this 5 years ago. So you can locate the start date has been picked up as 25th March 2019, and the end date would be the last trading day, that is yesterday's date. Next to that is the benchmark column. So right here you see reference index 3 is what has been automatically picked up by the platform. Now you want to know what is reference index 3. I go to this engine column right here in this gray section. I'll just click. So it tells me that a reference index 3 right here stands for 80% Nifty TRI and 20% CISL bond. Now this reference index has been auto benchmarked by the platform based on the asset allocation of the entire portfolio. So I just go to this asset allocation tab. So based on this asset allocation, the split between equity and debt, this asset allocation prompts the platform to suggest as reference index 3 the proper benchmark to be used against this portfolio. Now, there is no hard and fast rule to go forward with this specific reference index. This is what the platform suggests. You can go forward with any other reference index that you want. You also have an option to select benchmark either from TRI, NSE, BSE, as well as World. That option is also available. Next, in the asset allocation tab, we would be looking at the exposure that is coming towards the portfolio. I'll just click on this equity bar graph and it would show up all the equity exposure that is there currently towards my portfolio. So you can see equity exposure comes to a total of 65%. Now, if we locate at all the components of this portfolio, this is an all mutual fund portfolio. There is no direct stock holdings. But still, my portfolio is getting an exposure by all these stocks. Let's say I just locate at HDFC Bank as a stock and it has an exposure of 3.47% towards my portfolio. Now, you want to know where does this exposure comes from? You just click on this I button right next to the percentage. So this tells me that these are all the funds that are a part of my portfolio and they have held the shares of HDFC Bank as a stock. their individual percentage of exposure is mentioned in this exposure column. And accumulation of this exposure column comes to a total of 3.47%. Now, this exposure can also be viewed in for very minuscule component as well. So right here, 0.07% as well. Such level of exposure can also be viewed on this exposure tab. Next, if we just look at the total exposure of this portfolio, it has been mentioned as 97%. Rather than being 100, it has been mentioned as 97. So this doesn't mean that it is a wrong exposure that is being showed. It just means that I might have a specific arbitrage fund or a balanced advantage fund in my portfolio. And that specific fund might have short positions in its asset allocation. So right here, you can see balanced advantage. Kotak Balance Advantage Fund is right there in my portfolio. I'll just load this in a new tab. And I'll just move to the asset allocation of this respective fund right here. So you see this specific fund, Kotak Balance Advantage, has 59 derivative short positions, and that comes to a total of negative 20.74%. So out of the total exposure that you see right here, 97, from 100, we have reduced this specific exposure of 20.74. So I can just show that on the calculator right here. I'll just input 20.74. I'll multiply that with the fund's weightage in my portfolio. As I mentioned, it is an equally allocated portfolio with 9 items. So the weightage comes to a total of 11.11%. So this is the total percentage of short position in the portfolio, which is 2.304. Now I'll simply reduce 2.304 from 100. Right here, it shows 97.69. And that is exactly what has been showed right here. This exposure has been obtained after reducing the short position if there exists for any of the fund in your portfolio. Next, I move on to the concentration tab. So this tab tells us as the percentage of your total portfolio, what is the equity market exposure, equity market cap exposure. So here in the overviews tab, we had seen that equity has an exposure to an extent of 65%. Now this concentration tab shows you the split between large, mid and small cap in terms of that 65%. So you can see large is to an extent of 42%, mid cap is to an extent of 14 and small cap to an extent of 7%. Now, once you add this large, mid and small cap, it would come to a total of 65% right here. Now, right here, there is another pie column that you can see, which is mentioned as others to an extent of 32%. Now, everything other than equity that I see in this overview tab, everything excluding equity, the debt, cash, foreign equity, and others, once I add all these up, it would come to a total of 32%, and that amounts to others. Now, this data can also be seen as percentage of equity exposure. Right here, I just clicked on this drop down and you can view this as percentage of equity exposure. So as of now, what we have done is I have taken the equity exposure, the base as 100 of equity exposure. And on that basis, it is showing the split between the large, mid and small cap. Next, I move to the equity sector. So this tab basically shows us which sector is heavily weighted currently in your portfolio. So I just hover on this bar graph and it tells me that banks is heavily weighted sector towards this portfolio to an extent of 11.97%. You click on any of the bar graph. I have clicked on this finance bar graph. So it tells me in finance as a sector, these all are the stocks that have exposure towards your portfolio. In similar manner, you click on any of the bar graph. It tells me in banks as a sector, these are the list of stocks that have exposure towards your portfolio. And this list can also be downloaded in an Excel format as well. We have a CSV button right here. Next, I move to this performance chart. So as I mentioned, this chart shows the performance of the portfolio against that of the benchmark. Currently, the benchmark right here is taken as reference index 3. Now, this blue line graph is showing the performance of the portfolio, and the black line graph is showing the performance of the benchmark, which is reference index 3. clearly stating an outperformance by your portfolio against that of the benchmark, of course, in this time duration that we have considered right here. And you can view that right here as well. The blue peaks shows an outperformance by your portfolio in comparison to that of the benchmark. You can view that in numerical term statistics right here, cumulative return, which is basically the absolute return, which is at 120 percentage for your portfolio, while it is at 95 percentage for your benchmark, clearly showing an outperformance. Now, what was the risk that was undertaken by this portfolio as well as the benchmark to generate this level of return in this time duration of 5 years? So for that, I go to this annual volatility, which is basically the measure of standard deviation. So it tells me that the portfolio took a risk of 12 percentage, while the benchmark took a risk of 15 percentage. So you can say your portfolio generated better return at a lower level of risk in this time duration of 5 years that we are currently considering. And that can also be seen in terms of its Sharpe ratio, which is basically the risk adjusted return, which is higher for your portfolio at 0.77 in comparison to that of the benchmark. Next, we come to this historical and implied VAR. So, VAR basically stands for value at risk, meaning what is the value of your portfolio that is at a risk. At a risk of what? At a risk of losing. So, right here, you see 95 is what has been mentioned, meaning with a 95% of confidence interval, there is a 5% probability that if history were to repeat itself, your portfolio would go down by a total of 17 percentage, while your benchmark would go down by a total of 20 percentage. In simple terms, if I mean, let's say you have invested 100 rupees in both the portfolio as well as the benchmark. So your capital erosion, meaning the capital moving out for your portfolio would be 17 rupees, and the capital erosion for your benchmark would be 20 rupees. Now, the method of calculation of historical VAR as well as implied VAR remains the same. The only difference is the underlying factor that is used for calculating either of the two. So, historical VAR is basically calculated by considering the historical returns, while implied VAR is calculated by considering the historical volatility. Next, we come to the performance of your portfolio against that of the benchmark, which is reference index 3, and you can locate it right here, alpha, cumulative excess on benchmark. You can see it as 25 percentage, mainly due to outperformance of your portfolio against that of the benchmark. Next, we locate this up capture ratio and the down capture ratio. So up capture ratio tells us that when the benchmark was in a bull run, how quickly was your portfolio able to catch up with the benchmark. So right next to up capture ratio, you can see in an I button. I click on that, and right here in the up capture ratio, we consider only those months wherein the benchmark has generated positive return, irrespective of whether the portfolio generated a positive or a negative return. So let's say I locate this April 2019. You can see the benchmark return is a positive 0.82, while the portfolio return is a negative 1.9%. So right here, we have given consideration to the benchmark return. So month on month, we consider only those months wherein the benchmark generated a positive return, and correspondingly the returns for the portfolio during those respective months. Now, once these have been input, this is the return value that is obtained for the portfolio, 43%, while for the benchmark, it comes to 45%. Now, right here, you can see that up capture ratio has been mentioned as 96%. So the method of calculation is basically dividing the returns of portfolio with that of the benchmark. And we say higher the up capture ratio, better is the performance of the portfolio in comparison to that of the benchmark. And by higher, I mean it should be more than 100, because here we consider that the benchmark is at 100. So up capture ratio, the more, the better. Next is totally opposite is the down capture ratio, wherein when the benchmark was in a bear run, how resilient was your portfolio to the movements of the benchmark? That is what we understand by this down capture ratio. In a similar manner, I just click on this I button. Right here, we consider only those months wherein the benchmark generated a negative return, irrespective of whether the portfolio generated a positive or a negative return. So again, I locate this Jan 2020. So you see benchmark generated a negative return of minus 1.17 percentage, while the portfolio generated a positive return of 0.74 percentage. Once all these months are considered, right here you can see in the total returns for the portfolio as well as that for the benchmark. And for down capture ratio as well, the formula remains the same. The return of portfolio is divided by the returns of benchmark. And for down capture ratio, we say lower the down capture ratio, better is the ability of the portfolio to be resilient towards the movement of the benchmark when the benchmark is in a bear run. And again, lower, I mean, it should be less than 100. Next is this monthly statistics and the yearly statistics. So the monthly statistics right here, you can see 61 is what has been mentioned as number. So 61 basically means that in this time duration of 5 years that we have set, there has been a total of 61 months, out of which 44 months your portfolio gave in an up performance and 17 months your portfolio gave in a down performance. Now, it says that in this 44 months, the average monthly return by your portfolio was to an extent of 2.94 percentage. That is what is highlighted by this average column. And similarly, in the 17 months, when the portfolio gave in and down performance, the average monthly return for these 17 months was negative 2.72 percentage. You can also locate the best performing month right here. I'll just keep my cursor. April 2020, the best performance came by this specific portfolio to an extent of 10.24 percentage. And the worst performing month can also be corroborated. March 2020, negative 18% was the worst performance by this portfolio in this entire 5-year time duration. Next, I move on to the contributions tab. So this tab tells us how each fund individually contributed to generate portfolio return as a whole. So the first column shows in the components that form a part of the portfolio. The second column has been mentioned as the total return. So this column is basically the individual return that has been generated by each fund in this time duration of 5 years that we have set. So right here next to quant tax saver fund, it has been mentioned as 284 percentage, meaning that the individual return generated by quant tax saver fund was 284% in this time duration of 5 years. Now, its allocation in the portfolio, right here, it is allocated to an extent of 11.11 percentage. Basically, my portfolio is equally allocated. So based on this allocation, its contribution to the entire portfolio return as a whole comes to 24 percentage. So as of now, you can see that the portfolio is equally allocated. And this is the fund which has performed or rather contributed the maximum to generate the portfolio return as a whole. And the least contribution came from Sundaram Short Duration Fund. Its individual return was 23 percentage, but still it was allocated in the portfolio to an extent of 11 percentage. And it contributed to the portfolio return only to an extent of 1.99 percentage. So this contribution tab could help you to take in decision. Let's say this fund is generating a very least amount of individual return. You can either reduce its weightage in the portfolio or maybe remove it completely from your portfolio. So such decision makings can be done using this contributions tab. Next, I move on to the rolling returns tab. So this tab tells or rather shows us the consistency of our portfolio. Right here, by default, 260, 520 and 780, meaning 1 year, 2 year and 3 year rolling window simultaneously is what you can see. I'll just change this to annualized. And this entire time series is what you can edit as well. How you can edit is you just multiply the number of years into 260. And this can be edited. Once that is input, you just click on run. Now, let us just locate or rather see the performance of this portfolio using this line graph. So 520 rolling window is what I wish to focus. So I'll remove 260 and 780 from this line graph. So the process is basically simple. You just click on this specific 260. It gets unselected and as well on 780. So as of now, I am viewing this 520-day rolling window. And right here, I'll just keep my cursor on the very first point of this rolling returns line graph. So it has been mentioned as 22nd March 2021. Now this date that you see, 22nd March 2021, is exactly 520 days from the start date, which is 25th March 2019. So this says that if I had invested or any investor had invested in this specific portfolio exactly 520 days prior to 22nd March 2021, which is our start date, their return generation would have been a total of 15%. Now, anywhere you keep your graph, your cursor on, exactly 520 days prior to that specific date that you see, meaning exactly 520 days prior to 4th June 2021, if an investor would have invested in this portfolio, their return generation would have been to an extent of 18%. Now, right here, we can also locate the lowest percentage. I'll just locate that this lowest percentage for this 780-day rolling window has been shown as positive 13%, while in a 260-day rolling window, it has been shown as negative 25%. Meaning that the more you invest, or rather stay invested for a longer duration, even the lowest return that gets generated is a positive return that you can see. Next, right here, you also have an option to check the return ranges or the probability of generating returns by this portfolio in a return range that is determined by your client. So here I'll just change the window. I'll just make it as 520 because that is what we were analyzing. And let's say your client wants to know if this portfolio could have generated a return between maybe a 10% to a 30%. So I'll input that specific figure right here. 10 to 30 is what I have input in this second bucket. And this tells me that 92% of times, based on its historical performance, 92% of times, this specific portfolio has generated returns between this return range of 10 to 30% in this rolling window of 520 days. So you can create in such return ranges and check the probability of that specific portfolio to generate return in that specific return range. Next, I move on to the distributions tab. So this tab on the x-axis, the bar graph that you see on the x-axis basically shows you the return intervals. As of now, you'll be able to see 10 return intervals because that is what is default. You can see right here. And these return intervals are editable. Let's say I just want a clearer picture on this and I input 25 as the return interval and I click on run. So as of now, we are viewing the return period being on a daily basis. You can toggle between day, weeks, and month. So as of now, we are focusing on 1 day return. And right here, you can see in the total number of observations have been mentioned as 1232, meaning in this time duration of 5 years, there has been 1232 working days. And out of this working days, let's say I just hover onto this tallest bar graph. You can see two columns show up, interval and frequency. So next to frequency is what has been mentioned as 460, meaning out of this 1232 days, 460 days were such wherein the daily return ranged between 0.10 to 0.65%. And that is what has been mentioned right here, the modal frequency. This is what has been mentioned, the maximum number of times. This is the return that has been generated by this portfolio, daily returns that has been generated by the portfolio in this time duration of 5 years. Next, you can view in the average, mean and median, average performance by this portfolio, or rather the average daily returns that has been generated by the portfolio in this time duration of 5 years. Now, you want to see which is the, or rather how many days were such wherein your portfolio generated positive return, highest positive return. So you will have to move towards the extreme right hand side of this bar graph. Right here, you can see it tells me that there were 3 such days wherein the daily return ranged between 2.81% to 3.35%. Now, right here, you can also toggle between one week, 1 day, and 1 month. Let's say I just click this as 1 month and I hit run. So you see the number of observations have changed to 62. And the modal frequency, again highlighting the maximum number of times a specific monthly return range between this modal frequency, which says that 10 months was such wherein the monthly return ranged between 2.39 to 3.13 percentage. Next, I move on to the scenarios tab. So right here, this tab lets you to create customized scenarios of your own. So right here, you can come to this custom scenario section, click on add custom scenario. Let's say I want to do an year-to-date analysis. I'll input that specific time, name for that specific scenario. I'll input the start date, Jan 1st, 2024, and the end date as yesterday's date, and I'll click on Save Custom Scenario. So right here, it gets saved. I'll just click on this, and it tells me how my portfolio performed in this time duration that I have input, the custom start date and the custom end date that I have input, clearly stating that as of now, the portfolio is outperforming the benchmark, which is reference index 3. Excess return generation, meaning alpha of 2.95% is what gets generated. Now, the reporting options on a portfolio level is basically a PPT that would get generated on your end. You just click on Create PPT. So such a portfolio level PPT would get generated on your end, wherein you can see in the components, the top components and exposures of your portfolio, the asset allocation of your portfolio, the equity sector and debt exposure of your portfolio, the performance chart, the movement of the portfolio against that of the benchmark. Of course, in the time duration that we have set, what I have done was 5 years. Rolling returns as well as drawdowns. And these PPTs are editable as well. You can insert in multiple slides. That option is available. Next reporting option is a PDF that would get generated. You can have in a watermark of your organization as well. So this is the performance chart, the first page. So right here, you can see watermark as NGEN Research. Your company name can come in as a watermark. You can see in the top holdings and exposures of the portfolio, the AMC exposure, which is the heavily weighted AMC in the portfolio. Equity market and debt market exposure, as well as the rolling returns and the drawdowns tab. Now on a portfolio level, we also have a share link that gets generated. So once I click on this share link, so there are two options that you can see. The option to hide NGEN fund score. So right here, the fund score that you see, you can just hide just by clicking on this box. And also you have an option to lock in the start date and end date, meaning once you share this link, your client won't have the option to change the start or the end date. And as well, this link remains active for maximum of 7 days. You can just toggle between these days. Let's say you just want this link to be active for 5 days. I have input 5 and I'll click on create. So this link can be copied and you can open this in a new tab right here. So all the tabs that were visible to you on the platform will also be visible to your client as well. And what we had done was we just removed this NGEN fund score, and as well we have logged in the start date and the end date. All right, so that is it for the topic related webinar. If anyone has any query, you can either unmute yourself or write down in the chat box.
Yeah, this is Salil Kothari here.
Yes, hi, please go ahead.
Just wanted to understand in the balance advantage fund category, the
Yes.
equity exposure shown is the net equity exposure.
Okay, so when you click on a particular balance advantage fund, in this case it's Kotak,
Right.
what you see is when you checkbox that apply shorts option, what is getting displayed is the net equity exposure. That's 52, right? But if you turn that off, meaning if you uncheck that, then equity part will increase, right? It has become now gross equity. So 73% is gross. When you check that box up, negative 20 goes away, and therefore that becomes a net equity exposure.
Okay. While comparing funds in this category, do we have
Yes.
an option of checking out that thing?
Okay, so as of now, in a compare section, we do not have a net equity column to actually sort funds on the basis of highest net equity exposure. We always show them on the basis of gross equity only, right? But we are already working on incorporating the net equity as a percentage in the compare section as a column heading. Right, so you should see this release due, rather it is due 31st of March. So you should be seeing it on the platform starting Monday next week. So 1st of April, the release should be live.
It would be applicable for the multi-asset fund also?
Everything. So basically what you will see is, and so if you can go to the compare section. Yeah. Let's do one thing. Let's go to the portfolio and click on compare icon. So all the components of this portfolio will get added in the compare section.
Right.
Okay. Now, when you scroll on to the right hand side, once this gets loaded, we have the holdings column, right, which is color coded as blue.
Right.
Here we have a split equity, debt, and others. Right there. Here there will be one more column saying net equity. As of
Okay.
now, only gross equity gets captured. So anything that you add in the compare section will also have, it could be multi-asset, it could be hybrid, it could be equity savings, anything. It will have net equity and gross equity both.
Okay. Okay. Just one more query.
Yes.
This portfolio comparison or the portfolio understanding,
Okay.
which is shown is on the basis of the holding what we have today,
That's correct.
right?
Yes,
Do
it's
we
called current. So hypothetical historical backtesting on the current holdings. That's correct.
right? Do we have an option where we have done certain transactions which also gets reflected?
No, we do not have, or rather, we do not capture transactions anywhere on the platform as of yet.
Okay. Comparison through a scenario analysis, will that be possible if we do various scenarios, combining scenarios together?
You can definitely check multiple scenarios, but even if you have created scenarios, transactions will never be captured on the platform. So this will not take into consideration investment price, investment date, and anything of that sort. So you can definitely do a multiple scenario what if analysis, either in the point to point or as Ansu discussed on a portfolio level. But there also it is working on the same logic, right? So if this would have been the period that you would have had investments in, this would have been your return. Nowhere transactions are getting captured.
Okay. All right. Thank you.
No problem. Any more questions? Please let us know.
Hi, Menaka here.
Yes.
Yeah, when we try to upload some equity portfolio,
Hmm.
some ISN which are not getting captured. What are those ISN which are not getting captured? Is there any specific list?
No, so if there are any mutual funds and stocks which are already there in the database, their ISINs will automatically get captured. What happens is we have come across, you please ensure the ISIN number is correct, because specifically from Franklin India Prima Fund or something like that, what we have typically observed is one source. We're not sure what that source is. It transposes I into one, right? So and so if you can please load in a Franklin India Prima Fund in a new tab.
I'm talking about equity.
direct equity, right?
Yes.
Sure. So you just have to ensure that the ISIN number is correct and the analysis, or rather the fund or the stock, will get captured. For an example, what I have observed in Franklin is the correct ISIN number has, after 90, it is I and not 1. Some sources, when you download an Excel, show this as 1. And therefore, NGEN Markets, ISIN recognizer does not recognize this fund. You just have to change or make the correct editing in the Excel sheet and make that 1 into I, and then it will get captured. So if you have, as long as you have the correct ISIN number, the funds or the stocks should be added to NGEN Markets.
Okay, one second. Shall I give you some ISN? Could you check what would be the reason for not capturing this ISN? Is it possible?
Sure. Maybe we can give you a call post the webinar, and then we can discuss on this.
Yeah, sure.
Yeah, there's a question in the chat box. For what purpose is the option for entering capital amount used in creating PPT?
Right. So let's say if you are generating a fresh proposal for a client. Okay, let's say this client does not have any investment as of now, and then you're giving him this portfolio as his first investment portfolio, right? And then you would like to generate a proposal for him on the basis of this model portfolio that you have curated for the client. Okay, in that case, what you will do is you will run the detailed analytics, and then you'll click on PPT option, wherein you'll get an amount option. So let's say you want to give him a proposal of 10 lakh rupees. So you just put in capital, you put in 10 lakhs. And now once you click on create PPT, in this case, it's an equally allocated portfolio, right? So it will give you, or rather it will split the portfolio holdings in such a manner that that 10 lakh rupees gets allocated um, in the um, in the proportion of that 10 lakh rupees into 11% each. So it will be somewhere around 1 lakh 1,000 to every particular scheme. So we will, or sorry, 11% of 10 lakhs each. So we will see how that is typically looking like. So one second. Once the PPT gets loaded, so this is the second slide. And this is where the change happens, right? So 1,11,100 in every fund, because it's an equally allocated portfolio. This is where generating a rupee based or amount based proposal helps. If there are no more questions, Ansu, we can close for today.
Yeah, all right. Thank you all for joining in. You can visit our YouTube page right here. So all the webinars that would be recorded, we have a dedicated playlist for that. This is where all the webinars would be visible, and today's webinar will also be get listed right here. Thank you all for joining in. Hope to see you again next time with a new topic. Thank you.